Welcome back to the Daily Crypto Deep Dive. Chainlink. It's one of those names that's always there in the background. Reliable, consistent, almost invisible. But what if the token that built the data layer for the entire crypto economy is actually one of the most undervalued blue chips in the market? In a world where investors chase hype, Chainlink has quietly built something far more durable, an indispensable role in the infrastructure of decentralized finance itself. Every time a smart contract needs price data, weather information, cross-chain verification, or proof of reserves, there's a high chance it runs through Chainlink. And yet, Link's market cap barely scratches the top 20. So today, we're going to strip back the noise, break down what Chainlink has become in 2025, and ask a simple question. Is Link still hiding in plain sight? And could it be the stealth asset of the next bull cycle? Before we get into it, do me one favor. Tap follow, leave a 5-star rating, and share this episode with someone who still thinks Chainlink is just an Oracle provider. Because by the end of this, you'll realize it's the foundation for a trillion-dollar digital economy. Now, let's begin. Chainlink started in 2017 as a simple but powerful idea. Connect blockchains to the real world. Back then, smart contracts were limited. They could execute logic, but they couldn't fetch data. A contract on Ethereum couldn't see a stock price, a weather event, or an exchange rate. It was isolated, and isolation is the enemy of utility. What Sergey Nazarov and his team built was a bridge, a decentralized Oracle network that feeds verified, tamper-proof data into blockchains. It's the unseen plumbing that makes things like decentralized exchanges, stablecoins, and prediction markets actually function. Fast forward to today, and Chainlink has become the dominant Oracle provider across all major networks. It secures more than $25 billion in on-chain value every day, and its integrations span Ethereum, Polygon, Arbitrum, Solana, Avalanche, and over 30 other ecosystems. Analysts at VanEck recently called it the most systemically important middleware in crypto. That might sound like a dry compliment, but it's profound. It means that if Chainlink went offline tomorrow, half of DeFi would go dark with it. But here's where the story gets interesting. Because Chainlink's role is evolving from Oracle network to full-blown interoperability layer. Earlier this year, Chainlink launched CCIP, the Cross-Chain Interoperability Protocol. Think of it as the Swift network for blockchains, allowing data and tokens to move securely between chains without bridges. Those bridges have been the weak point of crypto. A third of all major hacks in the last 5 years came from bridge exploits. CCIP replaces those with Chainlink's validated, cryptographically secure messaging. And speaking of Swift, Chainlink isn't just inspired by them, it's partnered with them. The same Swift that handles over $5 trillion in daily cross-border payments is now testing Chainlink's CCIP for settlement and tokenized asset transfers. That partnership alone changes the narrative. It turns Chainlink from a DeFi tool into an institutional bridge, the connective tissue between traditional finance and blockchain infrastructure. Now, let's talk about what's under the hood. Because what makes Chainlink unique isn't just what it does, but how it earns its value. Link isn't a governance token or a hype coin. It's the fuel that powers the network. Node operators stake Link to provide data services. The more valuable and frequent those services, the more Link is locked up as collateral. It's a usage-driven economy, not speculation-driven. And that's where most investors underestimate it. You can't value Chainlink by retail hype or influencer chatter. You have to value it by usage, and usage is exploding. According to DeFi Llama, Chainlink oracles now feed data to over 1,800 protocols. They secure everything from Aave's lending pools to synthetic assets on Synthetix, and they verify reserves for stablecoins like True USD. That demand isn't cyclical, it's structural. Every time another Layer 2 launches, every time a new financial product tokenizes real-world assets, Chainlink becomes more essential. Analyst Tom Dunleavy put it this way. In the same way AWS became the invisible backbone of the internet, Chainlink is becoming the invisible backbone of DeFi. Let's pause on that comparison, because it's bigger than it sounds. When Amazon Web Services started, few investors understood that the infrastructure layer, not the flashy consumer apps, would create the trillion-dollar opportunity. Today, AWS generates over $70 billion in annual revenue. Chainlink could follow the same path. But let's not ignore the elephant in the room. Link has been through the grinder. After peaking around $50 during the 2021 bull run, it spent nearly 2 years grinding sideways between $5 and $9. That's tested the patience of even its most loyal holders. But here's what's fascinating. While most altcoins bled out, Chainlink quietly increased its market dominance. It added hundreds of integrations, doubled its partnerships, and secured some of the biggest names in finance, including Citigroup, DTCC, and ANZ Bank, all experimenting with Chainlink's infrastructure for tokenized settlement. And then there's staking. When Chainlink introduced staking version 0.1, demand was overwhelming. The pool filled in hours. It capped at 25 million Link, but with version 0.2, that limit expanded, and so did institutional interest. The staking model isn't yield farming, it's security provisioning. Stakers back the accuracy of data feeds, and if they fail, they lose collateral. It's a real economic incentive, not a marketing gimmick. Now, what does that mean for price dynamics? Two things. First, more Link gets locked in staking, reducing liquid supply. Second, the network's income, denominated in Link tokens, increases as data demand grows. In other words, usage directly drives value accrual. Now, here's where things get even more bullish. For years, critics argued that oracles were a commodity. Anyone could provide data. But in practice, no one's come close to matching Chainlink's reputation or scale. Ban Protocol tried. A PI3 tried. But neither captured meaningful market share. The reason? Trust. Chainlink has proven uptime, a spotless security record, and enterprise-grade credibility. It's like comparing a random startup cloud provider to AWS. Sure, it's cheaper. But would you bet billions on it? Meanwhile, Chainlink continues to evolve. Its upcoming data streams upgrade promises sub-second updates for high-frequency DeFi applications like perpetuals and prediction markets. That's something that previously required centralized APIs. Now it's being decentralized, with Chainlink leading the charge. And then there's its next frontier, real-world assets, or RWAs. Tokenizing assets like bonds, commodities, and even real estate has become one of the hottest narratives of 2025. BlackRock, Franklin Templeton, and others are already experimenting with it. But guess what underpins those tokenized assets? You guessed it. Oracle verification. When a bank tokenizes a government bond, it needs to prove that the on-chain token matches the off-chain asset. That proof mechanism runs through Chainlink. It's quietly becoming the audit layer for digital finance. Chainlink's current market cap sits around $10 billion. Ethereum sits around $400 billion. But Chainlink secures over $25 billion in value every single day across multiple chains. If you apply even a modest valuation multiple compared to traditional data providers, Bloomberg, Reuters, even smaller fintech API companies, Chainlink looks severely undervalued. Morgan Creek's Mark Yusko said it bluntly last quarter. Chainlink is the most asymmetric bet in large-cap crypto. It's a monopoly in a market nobody's pricing correctly. And when you break that down, the logic holds. Link has limited supply, 1 billion tokens, with roughly half in circulation. Over time, staking and utility lockups will continue to tighten that float. And as tokenomics mature, especially if the network adopts dynamic fee burns, scarcity meets utility in a way few projects can replicate. But valuation isn't just math. It's also narrative. And right now, Chainlink's narrative is shifting from forgotten infrastructure to comeback contender. Over the past few months, Link has steadily climbed back toward $20, outperforming much of the altcoin market. That may not sound dramatic, but the difference is momentum quality. Chainlink's rallies are driven by fundamentals, new partnerships, ecosystem updates, integrations with real enterprises, not speculative meme coin hype. It's the slow, steady climb that often precedes explosive moves when markets rotate back to fundamentals. And analysts are starting to catch on. A recent report from Into the Block noted that over 75% of Link holders are now in profit. a key psychological turning point. Historically, once that metric flips, new cycles tend to follow within months. Meanwhile, sentiment data shows rising whale accumulation and declining exchange balances, both bullish long-term signals. So, what could push Chainlink into true blue-chip territory? First, institutional adoption of CCIP. If Swift's pilot turns into production usage, we're talking about billions in potential transaction volume secured by Chainlink infrastructure. That would instantly make Link one of the few tokens tied to real enterprise-grade cash flow. Second, the expansion of real-world asset tokenization. Every tokenized bond or loan needs data verification. The more assets move on-chain, the more Chainlink earns. And third, integration with AI. It might sound abstract, but AI models thrive on trusted data. Imagine autonomous agents settling trades, logistics, or insurance payouts. They'll need verifiable, tamper-proof information. And that's Chainlink's entire purpose. The team has already hinted at partnerships exploring AI-Oracle interoperability, which could open an entirely new market segment. So, where does that leave us? If Bitcoin and Ethereum represent the monetary and computational layers of crypto, then Chainlink represents the informational layer. It's what ensures those systems can interact with reality safely. It's the glue that turns blockchain from isolated code into a functioning global economy. And yet, despite all of that, the average investor still treats it like a secondary player. That's what makes Link such a fascinating trade. It's a large-cap asset with small-cap sentiment. It has blue-chip fundamentals without blue-chip pricing. If history is any guide, infrastructure plays like this don't stay under the radar forever. Think back to 2020, when no one cared about base layer scaling until Ethereum's gas fees exploded, and suddenly Layer 2s became the new frontier. Chainlink could be the same story, an old name rediscovered in a new context. As DeFi reaccelerates and tokenized finance takes shape, demand for secure data feeds could multiply tenfold. And when that happens, the market will reprice Link not as a utility token, but as a cornerstone asset, the backbone of trust in a decentralized economy. Now, no deep dive is complete without acknowledging risk. Chainlink's roadmap depends on adoption, and enterprise adoption moves slowly. Competitors are always emerging, and decentralization critics argue that Chainlink's node network could still be more distributed. But in truth, no other Oracle system has achieved its level of security, partnerships, or reputation. That moat only deepens over time. The question isn't whether Chainlink will be used, it already is. The question is how big its footprint becomes as blockchain adoption spreads beyond crypto into traditional markets. Because when $1 trillion market migrates to tokenization, someone has to verify the data. And right now, only one network has both the trust and the technology to do it. So, as we wrap up, remember this. The market's loudest stories aren't always the most important. Chainlink doesn't scream for attention. It doesn't need viral memes or billionaire endorsements. It just keeps building, securing, and expanding. Quietly, relentlessly, and effectively. And in a few years, when investors look back on the early stages of crypto's infrastructure era, they might realize that Link wasn't just undervalued, it was inevitable. Protect your crypto with Ledger, the safest way to store Bitcoin, Ethereum, and yes, your Link tokens, offline and beyond reach. You can check it out through the link in the description. Drop your thoughts in the comments, share this episode, and don't forget to follow and rate the show. Because as the next wave of crypto adoption builds, the real winners might not be the loudest projects, but the ones that make the entire system work. And Chainlink might just be the quiet giant leading that charge. Thank you very much for listening. Stay safe, keep your crypto secure, and as always, we'll see you at the top.